I believe this fake-ass bull market is not going to last. Guys, let me show you where I think we are. There's a common chart out there where things go like this, and people ask, where do you think we are in the market? People are telling us, new bull market. I'm seeing it all over the place. The Goldman Sachs just increased their S&P estimate for next year. I'm seeing 6,000 across some people. Here's the interesting part, Mo. A year ago, when the market was down so much, people were pessimistic. It's proof that when people look at the future, they look at the recent past to dictate their future.
Right.
And it's absolutely insane because, guys, we are looking at valuations every single day. I update my valuations on two different metrics. The stock market to GDP ratio, which Warren Buffett calls a single most reliable metric on valuations at any given time. And for those of you who don't like it, there's the 10-year cyclically adjusted PE ratio, which takes the last 10 years of earnings in the S&P, brings it to today, and sees where the values are. Both are insane.
Insane.
Right now, we are 82% overvalued on the stock market GDP ratio.
And look at the last 4 quarters leading into this quarter.
Absolutely.
It's just a continuous climb.
And we got as low as 48.8%, but nobody was optimistic then.
No. A lot has happened in the market this year, from the incredible rise of NVIDIA to the bounce back of Meta and so much more. In this video, we'll double down on where we believe the market is, highlighting 4 main facets of the market to help indicate where we are headed.
Okay, so bull markets don't end just because they're old, right, Mo?
Right.
And we had the COVID crash in 2020. I don't really consider, I mean,
6 weeks.
Not even, I don't think it was even 6. I think February
weeks?
19th was the high, and then March 20th or 21st was the low. Yeah, and I look at that saying, okay, and then we immediately went up from there. We had record highs within a few months, right? So the real last time was 08. And I remember in October of 07, the market hit a peak, and it kind of like trudged down, and then September of 08, Lehman occurred.
Yeah.
Even earlier in the year in March, Bear Stearns had collapsed, right? Yeah. But didn't cause the market to crash. Just steady, and then all of a sudden, boom.
Right.
And we went from a high, I believe in October of 07 of 1,550 or so, and hit a low in March of 09 of 666. That was the intraday low. It's been 14, 15 years.
It's been a long time.
It's a long time. Again, it doesn't mean...
It doesn't mean it can't go another multiple years.
Yeah, but you sit there and say, is that healthy?
Right.
And what drove a lot of that big market up?
What we have right now?
Yeah.
I think a lot of it was giving away free money. A lot of it was lowering interest rates.
Well, that was by giving away free money and lowering interest rates, right? Now, guys, I mentioned the stock market GDP ratio before. The cyclically adjusted PE ratio, that actually takes the earnings of the S&P no matter where it was earned. And I look at this and I go to we're currently at 32. This is actually supposed to be today's. 87% overvalued, even higher than the stock market to GDP ratio. Look back at history.
Yeah, when was the last time we were around that level?
Right here. You look at overvaluation. You look at 30s. We hit a high before the crash in 08 of around 27.5. But really, it was right at the tech boom. We got a high of like 43 or 44. But guys, you saw what happened over the next 10 years. The tech boom happened, and we saw no growth for 10 or 12 years. You saw, because guess what? Every investment is the present value of all future cash flow. The more you pay, the less return you'll get. What you pay for the stock market isn't going to affect the future returns of the stock market in the sense of they're not going to pay you, they're not going to give you, if you pay more, they're going to give you more earnings.
Right.
No, what's going to happen is going to happen. But you look at this saying, is this healthy?
A lot of things are pointing to no.
Yeah. And now we're looking at, the other thing is, Mo, another point, see how many bankruptcies are happening this year?
Yeah.
Bankruptcies are on pace for a record year.
Bankruptcies, layoffs. I mean,
and the record year is not, is before COVID, because COVID had a bad year for bankruptcies.
Of course.
And you know, everybody hates bankruptcies. I look at other things like the consumer. Luxury goods sales are down 15% year over year.
Yeah.
Credit card balances, forget about the total dollar amount, the increase. Delinquencies have skyrocketed. Car delinquencies have started to increase.
Yeah.
You look at that, and by the way, car delinquencies shouldn't be affected by new interest rates because they've locked in their rates.
Exactly.
When they bought 2 years ago, they had a locked-in low rate.
I spoke to somebody in the used car industry over the weekend, and they said it is getting very, very rough out there.
Yeah.
They're struggling.
It's tough.
Yeah.
Is that your neighbor? Mm-hmm. Guys, the fourth and final point, the thing that just boggles my mind, interest rates. Yes. Back in March of 2022, just a mere 21, 22 months ago, interest rates were at 0%. They're now at 5.25%. Guys, that was supposed to be the big dagger for stocks.
we were told, as they were talking about raising interest rates, it was all about if they raise interest rates, things are going to fall apart and it's not going to come back.
And it fell.
It did.
And then
Rebounded
right back.
Yeah.
Because I don't understand this. So I look at this saying, if I can get 5 to 5.5% from a 90-day treasury, why would I want to take risk in stocks?
100%.
Well, euphoria. When people see stocks go up, they don't sit there. They have FOMO. They have fear of missing out. And that's what we talk about in this channel a lot. If you can just limit that FOMO and be rational about what you're buying, yeah, you will look dumb at times. And it could be extended period of time. But at the end of the day, what's more important? It's more important for you to have a long-term outlook that's reasonably accurate as opposed to 100% wrong. Mm-hmm. And when you overpay for things, that money is gone. You're going to get a crappy return going forward.
Yeah.
It doesn't mean that paying a high multiple is bad. If that company is growing like crazy, has a high return on invested capital,
then it's worth it.
You can pay a high multiple. Yeah. But for the market in general, the top 500 companies, when I see the top 7 companies in the country driving these gains, I sit there and go, how can the largest companies be the biggest growers? That doesn't even make sense. It doesn't make any sense.
Yeah. It's really hard to go from 1 trillion market cap to 2 trillion versus 1 billion to 2 billion.
Yes, but we see the 1 trillion to 2 trillion skyrocketing.
Yeah.
So to me, when I look at the markets and where they're falling from the outside, we warned you guys 2.5 years ago, and a lot of people listened. We said Tattooed Chef, and we listed all these companies that were crap companies. We're like, we don't understand this. And they've all fallen 90 to 100%, basically.
Or they're gone. Like
right.
You said, 100%.
And I look at that saying, that was the outside decaying.
Yeah.
And it's starting to come. Now, I went from having no stocks I owned to now I own 16 companies. Why? Because now the middle stocks started to fall a lot. And when those companies start to fall a lot, it gives opportunity there. The next will be the big market cap businesses. This happened in 2000. It happens at every major bull market. Now, the difference is we had a drop, and a lot of people now feel like, okay, bear market's over. We're back to all-time highs. Here's an anecdote. A friend of my brother's, very wealthy person, said to him the other day, I'm sitting on a lot of cash. I went, oh, no. And then he said, now's the time for us to get in. Me and my buddies all have a lot of cash, and we all think this is the right time. I'm like, and I might look at my brother going, so wait, 30, 40% lower prices wasn't the right time. Now's the right time.
30 or 40% higher prices.
Now 30 or 40% higher prices is the better time. You'd rather, it's the only thing in the world.
It's chasing the news.
News chases the stock price, not the other way around. So guys, we do not believe that we're experiencing a new long-term secular bull market. In fact, I believe that this is a clear bull trap. Everyone is dismissing past old news, all-time highs. So watch this video we made called The Opportunity of a Lifetime Financial Event, which will help you prepare if and when we enter a new bear market.